When we look at trade between nations, numbers often tell an initial story. Recent figures from India's Ministry of Commerce paint a picture of success. India has reported a significant trade surplus with the United States. This means India exports more goods to the US than it imports. For the fiscal year ending in March 2024, this surplus stood at $36.7 billion. Key Indian exports to the US include pharmaceuticals, gems, jewelry, textiles, and machinery. These goods find a large and receptive market in America. It reflects India's growing capabilities and its integration into global supply chains. However, trade is not just about physical items crossing borders. The modern global economy involves a vast exchange of services and significant capital flows. Only by examining all these components can we grasp the full financial dynamics at play. From the United States' perspective, the trade numbers with India often spark a different conversation. American policymakers and media frequently focus on the trade deficit. A trade deficit occurs when a country imports more goods than it exports. In the case of US-India goods trade, the US sees itself as having this deficit. This deficit is often portrayed in a negative light in political discourse. It can be used as a talking point to argue for tougher trade policies or protections for domestic industries. The concern over trade deficits is not new in American politics. For decades, successive administrations have pointed to trade imbalances as a problem. The argument is often that these deficits lead to job losses in the US. It is suggested that they indicate unfair trade practices by other countries. This narrative resonates with certain segments of the population. It simplifies complex economic issues into a narrative of us versus them. However, this focus on bilateral goods deficits can be overly simplistic. Many economists argue that bilateral trade balances are not the best measure of economic health. They point out that the US benefits from affordable imports. Therefore, the American scrutiny of the trade deficit with India, while politically potent, may not reflect the complete economic reality. A recent report has shed new light on the US-India economic relationship. The Global Trade Research Initiative, GTRI, presented a startling analysis. Their findings suggest the US enjoys a significant economic surplus with India. This surplus, estimated at $40 billion annually, is not visible in standard trade data. It contrasts the commonly cited US trade deficit in goods with India. The GTRI report includes trade in services and income from investments. When these factors are accounted for, the balance shifts in favor of the US. American companies earn substantially from their operations and investments in India. The implications of this $40 billion figure are significant. One major component of the hidden US surplus comes from the services sector. The United States is a global powerhouse in services. It exports a vast range of services from software and IT support to financial consulting and higher education. India is a significant importer of these American services. This trade in services generates substantial revenue for the US economy. This revenue stream is a key reason why the overall economic picture looks different from the goods trade alone. American technology companies, for example, have a strong presence in India. They provide software, cloud computing services, and digital platforms. Indian businesses and consumers utilize these services extensively. Similarly, US financial firms offer expertise and services in India's growing financial markets. American universities also attract many Indian students, whose tuition fees and living expenses contribute to US service exports. The surplus in services trade for the US with India is often substantial. The US consistently exports more services to India than it imports from India in terms of value. This surplus helps to offset the deficit seen in the goods trade. The revenues generated from services exports to India are a direct economic gain for the United States. Section 5. American investments in India, a story of substantial returns. Another crucial element contributing to the hidden US surplus is income from American investments in India. US companies have made significant foreign direct investments in India over the years. They have established factories, research centers, and service hubs across the country. These investments are not just one-way flows of capital, they are expected to generate returns for the American parent companies. These returns come in the form of profits, dividends, and royalties. Many leading American multinational corporations have a strong and profitable presence in India. Think of companies in sectors like technology, consumer goods, automotive, and finance. These firms tap into India's large and growing domestic market. they also leverage India's skilled workforce for their global operations. The profits earned by the Indian subsidiaries of these U.S. companies are substantial. A significant portion of these earnings is often repatriated back to the United States. This repatriation of profits represents a significant financial inflow for the U.S. economy. This income is not typically captured in the monthly trade deficit figures for goods. Section 6. Indian Enterprises in America, contributing to U.S. economic vitality. The economic relationship between the U.S. and India is a two-way street. While U.S. companies profit from India, Indian companies are also increasingly investing in the United States. Major Indian firms, especially in sectors like IT services, pharmaceuticals, and manufacturing, have established a significant presence in America. These companies contribute to the U.S. economy in various ways. They create jobs for Americans and invest in local communities. They also bring innovation and healthy competition. Indian IT service companies, for instance, are major employers in several U.S. states. They provide crucial technology services to American businesses, helping them to innovate and improve efficiency. Similarly, Indian pharmaceutical companies have invested in manufacturing plants and research facilities in the U.S. They contribute to the supply of affordable generic medicines, benefiting American consumers and the healthcare system. These contributions are tangible and valuable to the U.S. economy. The presence of Indian companies strengthens the American economy. It adds another layer of mutual benefit to the relationship. Section 7. Trade tensions, tariffs, politics, and the underlying economic reality. Despite the deeper economic benefits, the reported goods trade deficit often fuels political tensions. In the United States, this deficit has sometimes led to calls for protectionist measures. Tariffs have been a tool used by past administrations to address perceived trade imbalances. These tariffs can target specific goods imported from countries like India. The stated aim is often to protect American industries and jobs. However, such actions can have complex and often unintended consequences. When the U.S. imposes tariffs on Indian goods, it can lead to retaliatory measures. India might respond by imposing its own tariffs on American products. This can result in a trade spat, harming businesses and consumers in both countries. For example, U.S. agricultural exports or high-tech products could face higher duties in India. This tit-for-tat escalation can disrupt supply chains and increase costs. It also risks damaging the broader diplomatic and strategic relationship between the two democracies. A more nuanced understanding of the complete economic engagement is necessary. Section 8. Beyond a simple ledger. The symbiotic U.S.-India economic relationship. The economic relationship between the United States and India is far more than a simple accounting of exports and imports. It is a multifaceted and increasingly symbiotic partnership. Both countries derive significant benefits from their growing commercial ties. India gains from American investment, technology transfer, and access to the vast U.S. market. These factors contribute to India's economic growth, job creation, and modernization efforts. Conversely, as the GTRI report suggests, the United States also gains immensely. Beyond the hidden $40 billion surplus from services and investments, the U.S. benefits from India's large and dynamic market. American companies see India as a crucial growth area. The U.S. also benefits from India's talented human capital, particularly in STEM fields. Many Indians contribute to American innovation and economic dynamism, both in India working for U.S. firms and in the U.S. itself. This mutual dependency creates a strong foundation for a strategic partnership. The economic ties reinforce the shared democratic values and geopolitical interests of the two nations. The future holds immense potential for even greater mutual gains. Section 9. Conclusion. Why a deeper understanding of trade dynamics matters. In conclusion, the narrative of U.S.-India trade is far more complex and positive for the United States than commonly perceived. Official data showing an Indian surplus in goods trade tells only a fraction of the story. The analysis by the Global Trade Research Initiative, revealing a potential $40 billion annual U.S. surplus, offers a crucial corrective. This hidden surplus comes primarily from America's strong performance in services exports to India, and the substantial returns from U.S. investments in the Indian economy. Understanding these multifaceted trade dynamics is not just an academic exercise, it has real-world implications for policy and international relations. When political discourse is dominated by simplistic interpretations of trade deficits, it can lead to misguided policies. Tariffs and trade disputes based on incomplete information can harm both economies. They can also strain important strategic partnerships. Acknowledging the full scope of economic benefits is essential for informed decision-making. The US-India relationship is a prime example of how economic interdependence can be mutually enriching. While one country might have an advantage in goods, the other might lead in services or investment returns. Such a nuanced perspective can pave the way for even stronger collaboration.